You've ditched plastic straws. You buy fair trade coffee, and maybe you even bike to work instead of driving. If sustainability is important for you, or you want your investments to follow the same values you hold, that's where ESG investing comes in. But what exactly is ESG investing? And how do you apply ESG investing principles to your portfolio? My name is Chris Kovalchuk, and I'm an Associate Portfolio Manager at Claret Asset Management. And in this video, I'm going to walk through the ins and outs of ESG. ESG stands for Environmental, Social, and Governance. In the past, investing for a profit and making a difference were at two opposite ends of the spectrum. But times are changing, and profits and sustainability are no longer seen as mutually exclusive. ESG can be broken down into three types: general ESG, social responsible investing, or SRI, and impact investing. The biggest difference between general ESG and SRI is that ESG tends to be inclusive and SRI exclusive. An ESG conscious investor will invest in companies that value sustainability or have expressed a commitment to improve their business practices for the greater good. SRI investing, on the other hand, focuses on exclusion. This means excluding companies from your portfolio that engage in undesirable activities. They can include weapons manufacturers, alcohol or tobacco, and can be screened out completely based on an investor's filtering criteria. Now, what about impact investing? Impact investing is putting your principal where your principles are. Impact investors actively seek out and direct their funds towards companies that have a proven track record of making a positive social or environmental impact on the world. So, what does the future of ESG investing look like? In a recent Money Maze podcast, Schroders CEO Peter Harrison made an astounding prediction. He predicted that ESG will no longer be around in 5 years. Now, I know what you're thinking. Does Peter not care about sustainability? Well, it's actually quite the opposite. Peter thinks ESG investing will cease to exist because it'll soon be a given. And I agree. Eventually, every fund manager will use ESG analysis techniques as part of their investment process when evaluating a company. Remember, building a portfolio is a lot like building a house. There are a lot of different tools you can use. The more tools you have, the more you can do. Think of ESG as an additional tool to help build up your investments. And generally speaking, it's never a bad idea to scrutinize your investments closely. At Claret, we like to play the long game. We consider environmental, social, and governance issues in evaluating a business. We trust management to run their business effectively and consciously, and we expect them to go beyond the minimum required by law. In terms of the environment, we tend to stay away from companies focused on the exploration of land and harvesting natural resources. These commodity-based businesses are hard to evaluate, as management has no control over the selling price of their product. These companies are price takers rather than price setters. On the social front, we believe bad actors will eventually have a negative impact on the valuation of a business. Whether it's child labor, pay equity, or unfair practices, the impact on a stock price is important. And in the age of social media, offenders quickly find themselves in the spotlight. And that's never good for business. On the governance side, we're interested in the structure, alignment of interest, and operations that will lead the business to success. We believe the competitive forces of supply and demand over time will determine which companies are acting in the best long-term interest for shareholders. Thanks for watching, and for more tips on ESG investing, visit our website at claret.ca. And don't forget to hit the subscribe button.